Again from BPP, question number 96. Before we start reading the question, it is always good to first read the requirements so that you can remove the clutter and you don't get engaged with unnecessary information, because many times in question they give you unnecessary information. So it says what amount will be credited to equity on 1st April in respect of this financial instrument. So it looks like very straight away that it's a financial instrument which is probably a compound financial instrument which has a debt portion and an equity portion, and we have to split between debt and equity. We did it in our lectures, but let's do one question. We start reading it together. It says that an 8% 30 million convertible loan was issued on 1st April 2005. In financial instrument, you should always be paying attention to dates a lot. So it's an 8% coupon rate and it's 30 million and it's issued on 1st April 2005 at par, which means that you got 30 million. You did not sold it on premium or you did not sold it on discount. Interest is payable in arrears on 31st March each year. The loan note is redeemable at par, which means if it is $100 issue price, when you convert it to cash, you will again give $100, because sometimes they say that redeemable at premium, which means that you take 100 but you return 110. But we are taking 100 and we are returning 100 on 31st March 2008, which means 2006, 7, 8. It is a 3 years thing. Or convertible into equity shares at the option of the loan note holders on the basis of 30 shares for each $100 loan. A similar instrument without the conversion option would have an interest rate of 10%. We already know that convertible bonds, because they give option to get cash or shares because they are more attractive, therefore their rate is always less. I mean, a similar type of bond without conversion is 10%. Our bond is convertible, so we give 8%. So now you've got only two interest rates to consider. 8% is your coupon rate. Based on this 8%, you will calculate that how much interest you have to pay. So 30 million into 8%, probably 240,000 or something, you will have to pay the interest. But your discounting and compounding, everything should be done at 10%. Okay. For discounting and compounding, we'll do 10%. They already have given you the discount factors, so it makes your life easy. We just need to now put the numbers in place. Sometimes they don't give you discount factors. You have to calculate yourself. So what we usually are doing, so if you want to calculate, you can make it on a timeline. Or if I don't want to make on timeline, I can just put it like this, that first we calculate our tax liability, okay? Our tax liability will be like, I'm sorry, not tax liability, because we just finished the tax chapter. So our liability part. So what you have to give in year 1, year 2, and year 3. So you are giving here, 30 million, which I call it like 30,000 into 8%. This is the amount which you have to give. And if I put like equals to sign, it is 2.4 million. 2.4 million in year 1, 2.4 million in year 2, 2.4 million in year 3. And in year 3, you give another amount of 30 million, okay? I put it like this, 30 million. And then you've got your discount factors. So which discount factors you will pick up? You will pick up your discount factors at 10%, because all the compounding 8% we only use here. We calculated the liability. This is like, okay, let me call it your coupon rates are 8%, but discounting will be done at 10% factor, okay? So 10% factor is given like 0.91, 0.83, 0.75, and they give you cumulative. They give you cumulative because you could have done it in NVT as well. I will show you how to do it with NVT. I'm just using it in this way, okay? This is a little bit, it takes more time, but I'm just showing you. And then I will show you, I did not use this number. I did not use this number. Why did they give it? I will show you later. That's an alternative way of doing it. So these are the numbers which I get here. And when you make a total, it gives you a number of 28476. This is called your opening liability, 28,476,000. So what you say that when you issued it on 01/04/2005. On this particular date, when you issued the financial instrument or this bond, you would say debit cash, which is 30 million, and you would say credit bond liability on this particular date, which is 28,476, and you would say credit your equity. And the difference of these two will be your equity. 30 million minus 28476, it gives you an equity of 1.524. So they asked us on 1st April 2005, what is your equity? Your equity part is 1.524 million. This should be your answer. That's all. Now, if I extend this question, I may like to extend the question. Probably they ask you, let's suppose they ask you that what is the bond liability? Let's suppose if they ask me what is the bond liability at the end of the year. End of the year means 31st March 2006. Let's suppose they did not ask us. We are just doing it because it will help us in some other questions. If they ask you what is the bond liability, you would say that opening liability is 28476. Then you would say accrued interest, which means the interest which you are accruing, and that would be at 10%. And this is 28476 into 10%. This should be added. And let me just make these numbers rounding proper formatting. And then I would say interest paid or coupon paid, whatever you may call it. And that would be 2.4 million minus 2.4 million. And this would be your liability at the end of the year 1. If they had asked you, I'm just trying to do 2 questions from the same information. So this would be your closing liability year 1, at the end of year 1. And this thing is also called amortized cost, if you remember well. This is called amortized cost. We don't need it now. They didn't ask us, but if they had asked us, we would have done like this. They only asked us how much is the equity portion. We say it is 1.524. That's all. Now I come back to another thing, that why do we use this 2.49? Now this is called annuity. Annuity means that when you have to pay a fixed amount for a fixed period of time, you can use your annuity factor. So if I wanted to do it with using this number, how would I have done that? I would have said that, I would say that interest payments. So how many interest payments you will make? You would make interest payments like 2.4, 3 years. So 3 years annuity factor is given 2.49. They already have told you it is 2.49. So this 2.4 annuity, I'm going to find out the present value of annuity. So 2.4 million multiplied with 2.49. So I just put it here, the present value of interest payments. The present value of interest payment will come up to be like this. And then you would say, okay, let me call it PV. PV of interest payment, like present value of interest payment. And then I would say PV of principal. This principal amount which you have to return, which is 30 million. How much is that? So that should be done like this. 30 million multiplied by the third year factor, which was 0.75. Here you don't use a annuity factor because you have to pay 3 payments. So this is the sum total of 3. I mean, you should remember that this number 2.49, actually it is a sum total of these 3 numbers. So instead of multiplying with 3 times, you just multiply it 1 time. You make a total, which is 2.49, and you just multiply with 1 time. This 30,000 I have to pay only 1 time at the end. So I just multiply it with the third year factor. And if I do like this, and when I make a total, it will again give the same number, like 28,476 like this. So this actually in exam, if you would do, you should be doing it with this method. You should be doing it in exam with this method because it will save your time. You will see how much are interest payments. Okay, it is 2.4 million for how many years? For 3 years at 10%. So find out 10% 3 years annuity factor, multiply with 2,400, and then this principal only 1 time. So this would be like a short way of doing it. It takes a little bit more time. This is a short method of doing it. In any case, you will get the same answer. And this is our question number 1. We got the equity from the same question we just calculated. They can ask us 2 more questions we can do. Actually, this question is done here. It is finished here. If they ask you, how much is the interest cost? How much is the interest cost which goes to the income statement? You will say 2.8 million. This is your interest expense. And how do you record it? If you have to make the double entry for this interest expense, you would say debit finance cost, credit bond liability with the amount which is 2848. So if they had asked us what is the interest expense with reference to this financial instrument in the first year, answer is 2848. Please show the double entry. This is a double entry. If they ask you how much is your closing liability end of year 1, you would say 28924 because 28 was opening plus this interest minus what I already have paid. This is my closing liability. So we just actually from one question we try to make some manipulation and learn 3 things. Next is question number 97. As per our rule, we again start with what is required. At what amount will the loan note appear in the statement of financial position as at 31st March 2002? You are issuing it at 1st April 2001, and they're asking you at the end of the second year. So this is pretty much what we did in the previous thing. I was telling you that, closing liability, but closing liability not at the end of year 1, but at the end of year 2. So let's start reading it. It says that a 5% loan note was issued at its face value of 20 million. Direct costs of issue were 500,000. The loan note will be redeemed on 31st March 2003 at a substantial premium. The effective interest rate applicable is 10%. What amount will the loan note appear? So will appear at 31st March 2002. So what you need to understand in this question, the trick is here that it says that direct cost of the issue. So what you are considering is now not 20 million, but 20 million you never received, because you received only 19.5 million. So you should start with 19.5 million. A 5% loan note was issued on 1st April 2000 at its face value of 20 million. And then you got some direct costs. So what you received cash, that should be your opening liability. So you should be saying here that your opening liability is 19.5 million. So, okay, how did I do it? I'll just write down here. Okay, let me give explanation here, explanation column. It is 20 million minus 500. So my opening liability here is 19,500,000. Then you pay interest. So year 1, interest. And a substantial premium, we don't know how much is that premium. Interest expense is 10%. So you have here 19 million into 5 plus 10%. So it is 1950. And then you are paying some interest. It says that the effective interest, it is a 5% loan note. So interest paid. So let me call it interest accrued. Let's use the proper word. We call it interest accrued in year 1. And then you have interest paid. Interest paid in year 1. Interest paid in year 1 will be 20 million into 5%. So how much that makes? This is what we already have paid. So liability was this much, and this is what we paid. It is 1 million. So this is your closing liability. I call it, closing liability end of year 1. Closing liability end of year 1. And then we need to do second year. We go for the second year. You will say interest accrued in year 2. In year 2, again that is 10%. And that 10% will be this 20 multiplied by 10%. And then you would say interest paid in year 2, interest paid in year 2, and that would be the same fixed amount. Same fixed amount. And you come back to total. And your answer should be 21,495. Now let me explain you a little bit. Some numbers I want to explain. And here it will be like this. And I would say, closing liability end of year 2. End of year 2. So this is your answer, 21.495 million. 21.49 million, option is D. Your interest payments which you are making, they are fixed. 1 million here and 1 million here. They will not change because you are paying 5% on the face value. The face value of the bond is 20 million. 5% of the face million is 1 million. You are paying 1 million interest every year. That is pretty much clear. However, if you pay attention, these are changing. Your interest amounts are changing, because in first year you accrue 10% on the outstanding liability. In second year, your liability has already increased. It has already increased. So now 10% of 20 million becomes 2,045,000. Now, what is the redemption value? We do not know. And that's why we do not continue the table, because it said that the loan note will be redeemed at 31st March at a substantial premium. Now, how much is substantial premium? How much we are going to pay? We don't know. They only asked us that how much is the loan note? What amount will the loan note appear in balance sheet at 31st March 2002, which means end of year 2, and our answer is 21,495. This D option is the answer. It was quite simple question. Okay, question number 98. It says using the drag and drop options below. Now we don't see drag and drop. We are doing the book. Complete the statement to show how IFRS 9 financial instruments require investments in equity instrument to be measured and accounted for in the absence of any election of initial recognition. So if you remember that it is equity instrument, okay? So if it is equity instrument, it cannot be at amortized cost, because in amortized cost you have fixed percentages. Interest you are adding, interest you are paying, and in amortized cost you have contractual cash flows. Equity shares do not have fixed dividends and they do not have fixed market prices. So that's gone. Amortized cost is not possible. Equity things are always measured at fair value, which means market value. So if you purchase shares of some company, today you purchase share for 100 and tomorrow the market goes down to 90, you will immediately do in your books to 90. You have to go to fair value. And then which changes through what? and it should be going to OCI or profit or loss. You should remember that by default, everything of equity instrument should go into profit and loss. They only go to OCI if you elect to put them. We did that thing in our lecture as well, and I used the word irrevocable election. If you watch the video again, I said it twice, irrevocable election, which means that you have a right to pick them up and say that, okay, they must be at fair value, but I want to show them in OCI. And if you elect to do so, if you choose to do so, then it is irrevocable. Then you cannot change the decision. But in this question, they say, in the absence of any such election, that you don't make a choice. So if you do not make a choice, then by default, equity instruments should be shown at profit and loss. Okay. So equity instrument means some shares in some other companies, the ordinary shares in other companies, they go at fair value in the balance sheet, and any changes like this 190, if $10 is the change, this $10 will be shown in your P&L. So that's pretty conceptual thing. It's simple.